Hello everyone, I'm Elliot Yu, co-founder of Smart Bonds. Listen, when the mainstream and financial media can be bothered to take, a 30-second break from their sort of second-by-second, minute-by-minute coverage of technology stocks, right, to even look at bonds, they tend to focus solely on these inane but sort of exciting political and economic narratives. So this year alone, we've all heard stories about, President Trump's proposed takeover of Greenland, and the fact that a Danish pension fund sold $100 million worth of U.S. treasuries. Never mind that $100 million is 0.0003% of the $31 trillion U.S. treasury market. And it's less than 1/100% of sort of normal daily trading volume in U.S. treasuries. So it's completely meaningless. You also had stories just a couple of weeks ago about President Trump's nomination of Kevin Warsh to be the new Fed chair starting this May, and how that was supposedly hawkish. Now, never mind that the probability of 3 or more cuts, 25 basis point cuts from the Fed this year, priced into the Fed fund futures market, has actually increased since Warsh was nominated. And you've had the predictable sort of rehashed narratives about sticky inflation, higher for longer interest rates, and reminders, of course, about the 2022 collapse in the bond market. Never mind that, as I'll show you here in just a minute, a simple ratio, it's really sort of a Swiss Army knife for bond math, tells us that comparisons to the setup in bonds in late 2021 and early 2022 to today are downright laughable. Simply put, mainstream and financial media coverage of the bond market, it's downright pathetic. And the worst part is that the media's half-truths, fake news, and misinformation are prompting investors to ignore bond, credit, and preferred markets that offer high yields, in most cases monthly payouts, lower volatility than stocks, and stronger returns year to date than even the S&P 500. So in this short video, I'm going to debunk 2 very expensive myths about the bond market and give you a simple tool you can use to evaluate risks in bonds. So let's start with this. Myth number 1. If rates rise, I will lose a ton of money in bonds. Listen, your return from a bond comes from 2 sources. That's the price of the bond, right? And what's known as the carry. So the carry is basically the yield, the interest payments that are made on that bond, right? It's the income you receive from owning the bond. In Smart Bonds, we recommend bond exchange traded funds, or ETFs, rather than individual bonds, because it's a far simpler and more practical way for individual investors to get involved in this market. ETFs open many corners of the bond market that only institutional investors could access just a few years ago, as recently as 2021, 2022. However, the ETFs we recommend offer returns via the same 2 main avenues as owning a straight bond, right? The price of the ETF itself, which is based on the underlying prices of the bonds in the portfolio, and the regular distributions you receive from owning the ETF, which of course is based on the income you receive from the bonds in the portfolio. Now, specifically in the case of virtually all the ETFs we recommend in the service, all but I believe 2, this would be monthly distributions from these ETFs. Now, of course, as many of you are aware, the yield of a bond and its price are inversely related. So when the yield rises on, say, a 10-year or a 30-year treasury bond, U.S. government bond, right, that means that the prices of those bonds are declining. However, here's the key question to ask. How much does the yield have to rise before the decline in the price of the bond offsets the carry, the regular interest payments, and the yield you receive from holding the bond or the bond ETF? So enter what's called the Sherman ratio, and that's named after Jeffrey Sherman, Chief Investment Officer at Double Line Capital, who has recently kind of popularized this simple metric for bond investors, or talks about it a lot. This ratio is actually a concept that's been around for many years. Back when I was in graduate school in the 1990s, we just called it the break-even ratio. So it's nothing new, but I think you'll find it extremely useful, and most investors don't know about it. If you think a discussion of bond math, by the way, seems like too much for a holiday weekend, happy President's Day, by the way, here in the US, don't worry. The math, it really isn't complicated at all. You can calculate this ratio in 10 seconds from home. So here's the equation. The Sherman ratio is the yield divided by the duration. Just those two things. The yield on the bond divided by the duration of the bond. So simply put, the Sherman ratio tells you how much the yield on a bond must rise over a 1-year holding period before you start losing money. So if it rises by less than that, you're going to actually still make money in the bonds because of the carry. If the yield goes down, you'll obviously make even more money because the price of the bond is also going up. So let's use one of the most common exchange-traded funds out there tracking the U.S. government bond market as a sort of example. And that's the yield on the iShares 20-plus year Treasury ETF. That trades under the symbol TLT on the New York Stock Exchange, TLT. This tracks U.S. government bonds with 20 or more years until maturity. So the yield on that ETF is approximately 4.8% right now. And the duration of that ETF is about 15.45 years right now. Now, duration, if you're not familiar with that, it's a measure of interest rate risk on a bond. How sensitive the bond's price is to changes in rates. So the higher the duration, the greater the rate risk. Duration is measured in years. Now, as I said, if you're playing along at home, if you will, on this, you can find data on both the yield and duration for most bond ETFs on the ETF's website. So just do a simple online search for the symbol of the ETF, and usually just the term ETF is enough, and you'll find this information. Alternatively, many brokers and financial websites offer access to the same data totally free of charge. This is nothing proprietary or hard to find. So in this case, the Sherman or break-even ratio would be calculated as follows. The break-even ratio is equal to that yield of 4.8% divided by the duration of 15.45 years. And if you do the math, you'll find that's 0.31% or 31 basis points. A basis point is just 1/100th of a percent, and you'll hear that term a lot in the bond market. So this is an approximation of the rise in yields over the course of 1 year that would result in an overall total return of 0%. So a break even on that ETF. If the yield rises by less than 31 basis points, then you still make money. And if the yield falls outright, of course, you would make more money, a higher return than the current yield of 4.8%, because you're benefiting both from the carry and the rise in the price of the bonds in the ETF. Note that the Sherman ratio for TLT is very similar to the equivalent ratio for the current, what we call on-the-run benchmark 30-year Treasury bond. So that is for the 4.625% U.S. government bonds of November 15th, 2055. That's the current benchmark. The yield on these bonds is about 4.85%, and the approximate duration is 15.60 years. So the Sherman ratio would be 0.311. 4.85 divided by 15.6 equals 0.3109%. So here's a chart of the 30-year bond yield since 1999. So I'm going back the entirety of this century, right? The blue line on my chart shows the daily closing yield for the 30-year Treasury, while that red line shows the break-even yield right now. The rise in yields over just the next year from right now needed to offset the carry you'd earn by buying this on-the-run bond today and holding for a year. As you can see, we'd need to see yields rise above their 2023 peaks to levels we haven't seen in more than a quarter century before the 30-year Treasury starts losing money for investors in the next year. Now let's consider how this situation has changed over the past 5 years. In early 2021, the low yield for the 30-year Treasury bond was 1.65%. And the duration of the on-the-run long bond at that time was 22.5 years. So that means that the Sherman ratio at the time was 0.0733%, a little over 7 basis points compared to more than 31 basis points today. That made buying long-term treasuries a very risky proposition 5 years ago in early 2021. Just a tiny rise in yields from 1.65% at the time, believe it or not, to 1.72% was enough to wipe out a year's worth of carry yield. And remember, that longer-term treasuries carry far more interest rate risk than intermediate-term or shorter-term bonds. So longer-term treasuries have higher duration, we say. Think about the 10-year treasury, the one that's probably most commonly talked about. Today the yield is around 4.05% on the benchmark on the run 10-year, and the duration is around 8.1 years. So the Sherman ratio means we need to see yield spike by 0.5% over the next year to 4.55% in order for the decline in the price of the bond to offset that carry. Now, the highest yield we've seen in 2025, the highest yield we saw in 2025 for the 10-year was right around 4.63%. Now, in contrast, at the end of, so that would only be, even a spike to last year's highs would only be slightly worse than break even on the 10-year U.S. government bond. In contrast, at the end of 2020, let's go back then, the yield on the 10-year was 0.91%, less than 1%, and the duration was around 9.6 years, so more rate sensitivity. So the Sherman ratio was a paltry 9 basis points, 0.09% at the end of 2020. So the yield on the 10-year only needed to rise from 0.91% to about 1% to wipe out the carry for an entire year. Buying bonds at the end of 2020 was essentially a risky bet that the Fed would continue quantitative easing at a high rate, buying a lot of bonds to artificially depress yields over the long haul, depressing yields across the board, across the yield curve. Now today, the margin of safety is more than 5 times larger at 50 basis points. In smart bonds, I recommend intermediate term U.S. government and corporate bond ETFs as well, which offer even larger margins of safety from the current level. For example, the intermediate term corporate ETF I recommend, this is investment grade corporates, has a yield of about 4.8% right now and a duration of 6 years for a Sherman ratio of about 80 basis points. So yields would need to spike over 5.6% for the capital losses to offset the carry income on this bond. Now the yield on this ETF hasn't exceeded 5.6% since the highs back in the autumn of 2023, the highs for yields. In contrast, this same ETF offered a yield of just 1.7% back at the end of 2020 and 2.33% at the end of 2021. So the Sherman ratios on these two dates were just 19 basis points, that's 0.19%, and 27 basis points respectively at the end of 2020 and the end of 2021. So do you see how much bigger the margin of safety is today than it was before that 2022 bond bear market the media keeps trying to scare you about? So let's address that fear narrative directly. In 2022, that iShares 20-plus year Treasury ETF, now that's the TLT ETF, symbol TLT, generated a negative 31.41% return, a big decline, almost a third. That was a historic wipeout. But because rates were so low in late 2021, the Treasury market was uniquely vulnerable to such a shock. We can use this same basic ratio and relationship to calculate the rise in yields from the 2021 lows that was needed to produce a 31.41% decline. So at the lows in 2021, the yield on long-term treasuries only needed to rise about 1.47% from 1.65% to 3.12% to produce a nasty 31.41% decline. Now, as you can see in my chart here, before 2021, we'd seen 30-year Treasury yields over 3% as recently as 2018 and early 2019. Indeed, for most of the period from 2009 through 2018, 30-year Treasuries traded with yields above 3%. So in short, buying long-term treasuries in 2021, at the end of 2021 or early 2022, or buying the TLT ETF at this time was a very risky proposition because you only required a modest rise in long-term yields to normal levels that prevailed from 2009 all the way up through early 2019 to produce a historic wipeout for investors and devastating losses. Unfortunately, this really hurt a lot of investors, particularly those who hold money in so-called target retirement funds or stock and bond hybrid strategies. You see, these strategies are supposed to give you the low volatility and safety of bonds paired with the upside potential of stocks. However, these sort of one-size-fits-all robotic strategies largely ignore how risky bonds were back in 2021 and early 2022. They didn't adjust for that, which is something you could have seen in 15 seconds, right? If you calculated this break-even ratio, this Sherman ratio. In contrast, today, we'd need to see the 30-year Treasury yield rise to over 7% to produce similar negative total returns. So the 30-year Treasury yield hasn't been over 7% since 1994. In my view, the U.S. economy would likely enter a recession long before the 30-year Treasury yield spiked above 6.5%, let alone 7%. And when the U.S. economy enters recession, you usually see global investors buy treasuries as a safe haven. We can also use this same Sherman ratio to calculate approximate break-evens for other bond ETFs outside the government and investment-grade corporate space in the smart bonds that we hold in the smart bonds model portfolios too, right? So for example, the current yield on a high-yield U.S. bond ETF we recommend in smart bonds, well, it's about 6.1%, and the duration is about 5.1 years. So the Sherman ratio is 1.19%, meaning that the yield on these high-yield bonds would need to jump all the way to over 7.26% over just the next year for this ETF to start losing money. That's a pretty big jump. The Sherman ratio is a very useful, quick approximation metric for determining your margin of safety in bonds. Now, don't let the bond illiterate mainstream and financial media convince you to avoid the bond market by bringing up the specter of the 2022 bond market collapse, which ignores this basic maths. Fixed income and related markets actually offer attractive carry right now, and accordingly a margin of safety near 15-plus year highs. So let's dive into myth number 2, the mythical bond market and rotation. When most investors today hear the term stock market, you probably think of the S&P 500, right? When I started in this business in the 1990s, I'd say the Dow Jones Industrial Average was the primary definition of the stock market for many individual investors. So what's meant by the bond market? When you hear these words on the mainstream and financial media, they're usually talking about the U.S. government bond market. In my experience, it's the 10-year U.S. Treasury bond that hogs all the attention. Sometimes perhaps the long bond, which is just a term that refers to the 30-year U.S. Treasury bond. In contrast, money managers who focus on bonds often benchmark to the Bloomberg U.S. Aggregate Bond Index, much as equity market investors benchmark to the S&P 500. However, even the Bloomberg U.S. Aggregate Bond Index is heavily weighted in favor of U.S. government bonds. So U.S. Treasuries account for almost half the index, and mostly agency-backed mortgage-backed securities, or MBS, which do tend to track Treasuries pretty closely, represent another quarter of the index. So that's 75% almost. U.S. investment-grade corporate bonds account for the vast majority of the rest of this index. The Bloomberg U.S. Aggregate Bond Index has no allocation to high-yield bonds, no allocation to preferred stocks, or credit instruments like senior bank loans, which offer very high yields. And much like the S&P 500, the U.S. Aggregate Bond Index also has no allocation to international bond markets, including corporate bonds issued by foreign companies or U.S. companies in currencies like the euro or the yen, government debt or U.S. dollar and local currency emerging market bonds. However, the real bond market is far, far more than treasuries and U.S. investment-grade corporate bonds. And in smart bonds, we focus on many of these overlooked corners of the bond market that have been and continue to offer much higher yields and stronger total returns than treasuries, and indices like the Bloomberg U.S. Aggregate Bond Index. So let's break it down. Most investors are familiar with the concept of rotation as it applies to the stock market. For example, a major theme so far in 2026, one that I've written about a great deal in equity-focused sister publications to smart bonds, is that technology and growth stocks that have led the market since those late 2022 lows, they're now lagging. Money is rotating out of tech, growth, and the Magnificent Seven stocks like Microsoft and Nvidia, and into more cyclical and value groups like energy, basic materials, and industrial stocks. Indeed, so far this year, the S&P 500 Technology Index, which is the highest weighted sector in the S&P 500, well, it's actually down 3.83%. And the S&P 500 itself is basically flat if we include dividends. Meanwhile, energy stocks have soared 22.34%. Industrials are up almost 12% this year. However, even on a combined basis, energy and industrials account for less than 11% of the S&P 500, right? Compared to a weight of more than 36% for technology alone. Equity investors who solely watch and invest in the capitalization weighted S&P 500 or ETFs like SPY or S&P 500 index funds, well, they're largely missing out on the superior returns in groups like energy. They're missing out on the returns in small cap stocks, sectors like industrials too, since late last year. And they're also missing the dramatic outperformance of global stocks for more than a year now. The global stock market, excluding the US, the MSCI World ex-US index, well, that's up about 44.5% since the end of 2024, compared to a 19.5% gain in the S&P 500 over the same holding period. So just like the stock market sees rotation periodically, the bond market also sees rotation. Investors who solely watch the treasuries that dominate U.S. bond benchmarks and media conversation are missing out on sizable rallies underway in other niches of the global bond, preferred, and credit markets we track using exchange-traded funds in smart bonds. You see, contrary to the media narratives, the bond market isn't just 10 and 30-year treasuries in the same way that the stock market isn't just Microsoft, Nvidia, and Amazon.com. Ignore the rotation underway in both equities and bonds, and you're missing out on the most powerful moves in both markets, and you're taking on far too much risk and volatility, way more than you need to. Take a look. This chart shows the performance of a number of themes and niches of the bond, credit, and preferred markets we recommend in smart bonds so far this year. For reference, I've also included the Bloomberg US Aggregate Bond Index and the S&P 500. As you can see, many segments of the bond market we cover this year are performing well in absolute terms and trouncing U.S. Treasuries. Many segments are even beating the S&P 500 year to date. I hope you found this video presentation useful. You can use that Sherman ratio I showed you to get a better handle on your interest rate risk in individual bonds, bond funds, and bond ETFs. And while the U.S. Treasury market is very important, some of the best opportunities right now, and really over the last couple of years, have been in under-the-radar niches of the global bond, credit, and preferred markets. These are rarely discussed in the financial media and get almost no play in a market obsessed with short-term moves in stocks like Microsoft, Nvidia. However, these secret corners of the global fixed income markets offer higher yields, lower interest rate risk, lower volatility, and stronger total returns than even stocks in some cases. If you'd like to see exactly what I'm recommending in the paid tier of smart bonds right now, I am offering 60-day free trials to the paid tier of this service for a strictly limited time. This is totally a free trial, not a risk-free trial. So that means you sign up today, try the smart bond service free for the next 60 days, read our regular updates and issues, and our next quarterly deep dive report, which is due out in March, just next month of this year. As questions, you can ask questions, via the paid subscriber only comments section here on Smart Bonds, or by sending me an email directly at the email address on the site. And only then decide. If Smart Bonds isn't for you for any reason whatsoever, just cancel your membership before your 60-day free trial is up, and your credit card won't be billed for the service. I guarantee it. Now, following that trial period, we also offer prorated refunds on your remaining subscription term if you decide that you no longer want to have the paid tier of Smart Bonds. So thanks for listening. I hope you found this video useful, and I look forward to greeting some of you as new free trial members of the Smart Bond service here in just the next few minutes. Thanks again.